or when we say it's a hybrid, what do we mean? Suppose two things are combined. So some two varieties of rice are combined to create a new variety, which will yield more. The idea is that it will yield more benefit for the farmer. So hybrid variety is where local desi variety and foreign variety is combined. So hybrid is here in finance we call it as a debt and equity are two types of finances. When these are hybrid security is a security having the characteristics of debt as well as equity. Allow greater flexibility to postpone payment of servicing debt compared to traditional form of debt. For example, let us say convertible debenture is there. So let us say fully convertible debenture or partly convertible debenture is there. We are going to discuss all this here. So in this case, the usually debt will be carrying lower rate of interest compared to equity. But in the case of FCD, the interest rate will be slightly higher because it contains a provision for converting it into equity. And also in case of a debt, suppose the company borrows money, so it has to make interest payment from the next month onwards. But in the case of a preferential security like preference share, it need not declare dividend every year. Even if it makes profit, it need not declare. So hybrid security is a security which is having the characteristics of both debt and equity. Beneficial to all parties, both the parties involved, including investors, shareholders, and issuers. Include preference shares, warrants, convertible debentures, and bonds, foreign currency convertible bonds, mezzanine financing. So all these we are going to cover now. Considered to be innovative. So if a hybrid security is considered or deemed as innovative, if the reward of the security is connected to some general economic variable, such as the interest rate, exchange rate, or commodities index, etc. So if it is done like that, then we call it as an innovative instrument. So a hybrid instrument is called an innovative instrument if the rate of interest is linked to such interest rate, exchange rate, or commodities index. So advantages: higher yield compared to debt. So for the person who is giving finance to the company, he get a higher rate of interest than debt, and less volatility compared to equity. Volatility or change will be less. Risk diversification of risk is also possible. So these are the three advantages. Disadvantages: assessment is difficult, calculation of return not very simple and straightforward, and investing is more complicated in these cases. So these are the disadvantages of this security. So equity investment by promoters and investors. Residual claim. When we say residual claim, when the claim of all other people are paid, then only if anything is left. So equity, we know equity shareholder will get something only if all other people are paid. So debt people who have given loan to the bank, loan to the company like bank, etc. When all are paid, if any money remains, then that will be the share of the equity shareholder. So in case nothing is there, he will lose only his equity share value. He will lose. He will not be asked to contribute more than his equity share value. Then managerial control and authority, because they are the owners. Equity shareholders are considered owners of the company. They have the control over the company and authority over the company. Managerial control and authority over the company. In the case of debt, this is a fixed claim. Fixed claim is nothing but the rate of interest payable is called fixed claim on the cash flows and assets of the company. So a debt holder has claim over all the assets of the company and also on the cash flows of the company. Unless the debt holder is paid, he can go to a NCLT or a court of law and ask for the dissolution of the company. No managerial control and authority over the company. Then third one is preference share capital. This is called the hybrid security. So we have equity, we have debt. Then preference share capital, this is considered as it's a hybrid security. Also called preferred stocks, do not carry voting rights. So voting rights are available only for the owners of the company. There is only one exception here in the case of a preference share capital. There is only one exception, which we will see next. Guaranteed. So there but fixed dividends before ordinary or equity shareholders are paid. So the preference shareholders are eligible for a fixed dividend, but it is guaranteed. But before the ordinary shareholders are paid, the company may choose not to pay the dividend to the preference shareholders. But if they want to pay some dividend to the equity shareholders, first they have to pay the preference shareholders. Then only they can declare dividends for the ordinary shareholders. Prior claim over equity shareholders on liquidation of a company. In case the company goes into liquidation, the preference shareholders will have a prior claim over the equity shareholders. Preference shares can be redeemed. So these preference shares can be redeemed, but equity shares cannot. There is no such thing called cannot be redeemed, but they can be bought back by the company. Preference dividends can be cumulative also, whereas equity share dividend cannot be cumulative. Perpetual irredeemable preference shares. Perpetual means in perpetuity or there is no redemption period, but it is not permitted in India except for banking companies. Only banks are permitted to issue irredeemable preference shares. Maximum period, often asked in exam, maximum period for which preference shares can be issued in India is 20 years in the case of other than infrastructure and 25 years in the case of infrastructure. So please remember these numbers: 20 years other than other than infrastructure, 25 years for infrastructure companies, and perpetual irredeemable preference shares can be issued only by Indian banks in India. Types of preference shares: cumulative preference shares. As the name suggests, suppose 20% is the preference dividend. If the company in 2025-26, the company is not able to pay the dividend because there was not enough money or the company does not want to pay. So suppose in case of cumulative preference share, in case of 2025, 2026, 27, the company has to pay for both the years. So 2025, 26 as well as 2026, 27. That is called the cumulative preference shares. So if the dividends are skipped for any reason for 1 year, in the next year, for the previous year also, they have to declare dividend. Right to receive a dividend at a predetermined rate. The predetermined rate is at the time of issue of the preference shares, it is mentioned. The dividends will continue to accumulate until they are completely paid out. Until the entire amount is paid out, they will continue. Unpaid dividends are treated as contingent liabilities in the company's balance sheet. So if any year it is dividends are unpaid, they are treated as contingent liabilities in the company's balance sheet. These are all, please note that all are in respect of cumulative preference shares. These these points are not applicable for non-cumulative preference shares. Delay in payment of dividends for 2 years and above. In case of cumulative preference share, if the company fails to pay dividends for 2 years and above, the cumulative preference shareholders have a right to participate in every resolution, all the resolutions, all the decisions or items before the general body meeting of the shareholders. So this is a dangerous trend for the company. So it will try to pay it will not delay it for more than 2 years. Non-cumulative preference shares, where if the dividends are not paid for 1 year, they cannot be carried forward for the next year. Then participating preference shares. When we say participating, it is participating in the profit of the company. So the participating preference shares can participate in the profits of the company after some fixed amount of percentage of dividend is paid for the equity shareholder. So in addition to the predetermined fixed dividend, suppose let us say 20% is the rate of dividend for these participating preference shareholders. So in addition to that, they have a right to participate in any surplus profits after equity holders have been paid dividends at a predetermined rate. Let us say the determined rate is fixed as 50%. In case the equity shareholders are paid more than 50%, then the preference shareholders should also be paid at a predetermined rate. So that is called the participating preference shares. Is it clear, friends? In case of liquidation, entitled to receive a predetermined amount of surplus after equity shareholders have been paid in full. After payment of equity shareholders, if anything is left, then they are also participating preference shareholders are eligible to participate in these profits. Non-participating preference shares, as the name suggests, they are not eligible to participate in the profits of the company. Redeemable or callable preference shares. There are two things here. There are two options. One is called the call option and another is called the put option. Option is the right but not the obligation. So when we say preference shareholders have a call option, they can purchase the shares at a predetermined price. So if the company has the option, then it is called a call option. If the company, suppose the preference shares are issued for, let us say, some 20 years. So if the company, in this case, in the prospectus, there is a clause that after 10 years, the company can exercise the option to buy back the preference shares, then it is called a call option. So if instead of the company, if the preference shareholders have the option, then it is called a put option. So please remember, call option is option for the company and put option is option for the preference shareholders. These are redeemable within 20 years from the date of issue or 25 years in case of infrastructure or even earlier at the company's option. Please note that callable means at the option of the company. So these are also known as callable preference shares, as the company may redeem them at specified time and at specified rate. But these have to be given in advance. The company after 5 years, it cannot suddenly say. So even at the time of issue of the shares, the company has to specify that they have the option to call call back the shares after 5 years or 10 years. Is it clear, friend? Non-redeemable or irredeemable preference shares, so can be redeemed by a company only on liquidation. Redeemable here, redeemable or callable means it can be redeemed before the due date. For example, the 20 years is the preference shares are issued for 20 years. But at the time of issue, the company can say at the end of 10 years or at the end of 15 years, the company has the option to buy back the shares from the preference shareholders. So if the option is with the company, we call it as a callable call option. If the option is with the preference shareholders, then it is called a put option. Okay. Just everything, madam. So we have seen that irredeemable preference shares cannot be issued by companies other than banking companies in India. Only banks are permitted to issue irredeemable preference shares in India. All others cannot issue this. Then convertible preference shares. Preference shares can be converted, convertible preference shares. Right to convert them into equity shares at the discretion at the specific price and time, depending on the terms and conditions of the issue. It is the most versatile form of preferred equity. So these preference shares can be converted into equity shares by the, at a specific price and time. So these are decided at the time of issue. So at the time of issue of the shares itself, the company says that at the end of a period, either the company or the shareholders have the option to buy them at a certain price. It is the most versatile form of preferred equity. Shareholders earn a fixed return through dividends and the possibility of higher returns if the company's share price rises. So non-convertible preference shares, these cannot be converted into preference shares. Adjustable rate preference shares are the rate of do not qualify for a fixed dividend rate. The dividend payouts depend on the interest rates prevalent in the market. So maybe they say repo plus 2%, repo plus 1%, etc. or some LIBOR rate or some other rate. So interest, depending upon that, the rate of interest is fixed. So adjustable rate preference shares are, here there is no fixed rate of interest dividend, but it depends on the interest rates prevalent in the market. Purpose of issuing preference shares. Why does a company issue preference shares? Improved method for acquiring capital in a dull primary market. The market is primary market is dull, or the IPO, initial public offering market, is dull. Like in the present case where the Iran, US war, etc. are there. Improved method for acquiring capital in a dull primary market. In some investors want more consistent dividends and stronger bankruptcy protections. Can be redeemed when there is a surplus cash and when there are no other successful ventures for a company. So a company wants to have a lot of surplus cash, so it wants to buy back the preference shares. Help keep the debt to equity ratio lower. Please note that preference shares are considered as debt, not as equity. Only equity shares are common stock is considered as a equity. So preference shares are considered as part of the debt. So for it helps improve the debt equity ratio. If there is a loss or reduction in profit, there is no dividend payout. So in case of preference shares, non-cumulative preference shares, there is no guarantee that payment will be paid by the company. In case the company is not making enough profits, it can skip dividends for a year. By issuing preference shares, a company can raise finance for long term without creating any charge. Please note that in case of debenture, etc., the company's assets are or cash flows are hypothecated, mortgage or hypothecation over its assets. But in the case of preference shares, there is no such charge or mortgage. Also, rules for acceptance of deposits are not applicable for preference shares. For a company like Muthoot Finance, so they can they can accept deposits. An NBFC, what is the period for which it can accept deposit, minimum and maximum? For bank, what is the minimum period for which it can accept deposit? So in case of NBFC, it is minimum 1 year, maximum 5 years. So 1 year to 5 years, so minimum 1 year only, and maximum it can issue only, accept deposit only for 5 years. That too only term deposit, cannot accept current and savings deposit. So that is the basic difference between a non-banking finance company and a bank. So, but in case of preference shares, the preference shares can be issued up to 20 or 25 years, and hence these rules of deposits are not applicable for them. Redemption of preference shares may be redeemed at a fixed time or on the happening of a particular event. Anytime at the company's option. So when we say at the company's option, we call it as a call option. Anytime at the shareholders option, this is called the put option. So please remember, call option is option by the company and put option is option by the shareholder. So it is, but both are decided at the time of issue itself. So this is regarding all these the different types of preference shares. So preference shares are basically considered as debt. So and they can be issued up to 20 years and up to 25 years for in case of a infrastructure company. Irredeemable preference shares in India can be issued only by banking companies, other than banks cannot issue. So these are some of the features of preference shares. So this is very important topic. So perpetual, we have seen that irredeemable or perpetual preference shares can be issued. This is called perpetual non-cumulative preference shares. When we say non-cumulative, if dividend is skipped for a year, it cannot be carried forward. So perpetual non-cumulative preference share, PNCPS. These can be issued by Indian banks as part of additional tier 1 capital or AT1 capital in Indian rupees. So these shares, preference shares can be issued as part of AT1. We know that for an Indian bank, so we know that what is the tier 1 capital, core CET1 how much, tier 2 how much, CET1. We have three types of capital. One is called CET1. The additional is called core equity or common equity tier 1 capital. The second one is AT1 and another is tier 2. So these are the three types. So total how much? Total for capital adequacy for banks? This is 9%. So tier 2, it is 2%. So we know that tier 2 capital cannot be more than 2%, cannot be issued. And so 1.5% is the AT1. So additional tier 1 capital can be up to 1.5%. So what is the balance? So 5.5%. So CET1 is 5.1%. So the PNCPS is issued as a part of additional tier 1 capital. So it can be up to 1.5% of the risk-weighted assets of the bank. So a bank can issue is up to 1.5%. In case it issues more than 1.5% of the capital, then it will be considered as tier 2 capital. Tier 2 capital can be maximum up to 2%. So excess considered under tier 2 capital is less than 2%. Total capital can be not more than 9% of the risk-weighted asset for a bank. Are we clear, friends? Are you able to follow? 5.5% plus 1.5 plus 2, that is the maximum. So in case more than 1.5% of the risk-weighted asset is issued by a PNCPS, it can be issued, but it should be not exceed more than 2% of the tier 2 capital. No maturity date. That is why we call it as a perpetual. No step-ups and other incentive. No incentives can be given. And the dividend can be a fixed amount, fixed rate of interest, or it can be a floating based on some market determined benchmark rate. Option is no put option. So the investors in these tier 2 in PNCPS, they have no put option, but call option, that is only the bank can exercise the option after 5 years with RBI clearance, because there is no maturity date. So after 5 years, the bank can approach RBI for call option. Principal repaid only with the prior approval of RBI. Well, prior approval of RBI is required for payment of the or redemption of the principal. Discretion, bank must have full discretion to cancel distributions or payments. Dividends can be neither cumulative nor have a credit sensitive coupon feature. PNPCS should absorb losses at a pre-specified trigger point, either by converting to common shares or by writing down the instrument. Suppose, let us say, a bank has issued, let us say, some 100 crores of AT1 bond as a PNCPS. So suppose in case the company is incurring losses and it is not able to redeem it, then what it can do, this 100 crores then can be a part of amount can be written off by the bank, and the PNCPS should absorb losses at pre-specified trigger points, either by converting into common shares. So these can be either converted into equity shares, or it can be a part of it can be written off also by the bank. Then seniority of claim. Please note that this is different. Sometimes it's asked. Superior to the claims of the equity investors. So the equity investors have a residual claim only on the assets of the bank. So equity investors, preference will be next to the perpetual non-cumulative preference shareholders. So seniority of claims superior to the claims of the equity investors, subordinates to the claims of PDI, perpetual debt instruments, all tier 2 capital instruments, depositors, and general creditors of the bank. So their claim is inferior to, subordinate to the claims of tier 2 capital instruments, depositors, creditors of the bank. It is neither secured, it is not a secured one, nor covered by a guarantee of the issuer. So a bank cannot issue guarantee for this payment of principal or interest. FIIs and NRIs, foreign institutional investors and NRIs can invest. FIIs can invest up to 49%, and NRIs can, non-resident individuals can subscribe up to 24% of the issue. With each investor is limited to 10% for the FIIs and 5% for the NRIs individuals. Not eligible for any voting rights. So these are some of the conditions. Very, very important topic from your exam point of view. Any doubts, friends? So these two slides are very, very important. Please remember. So preference shares redemption. A company can use the proceeds from fresh issue of shares to redeem the preference shares. So it can issue fresh issue of equity shares for redemption of preference shares. If fresh issue is at premium, if the shares are issued at premium, this premium account, share premium can be used for payment of fully paid bond securities, to write off preliminary expenses or commission, etc. So the next one is warrants. Any doubts, friends? So a company can issue, a company or a bank can issue fresh issue of shares for redemption of preference shares. And if the fresh issue is a premium, the share premium account can also be used for issue of fully paid bond securities. Warrants, rights but not the obligation. So it is like similar to the options. The warrant holder has the right but not obligation to purchase a predetermined number of shares, equity shares, at a predetermined price during a predetermined time period. So for example, we'll take one simple case.